When it comes to investing, there's one single idea that can be the difference between sleeping soundly at night and, well, not. Today, we're diving into the power of diversification. And trust me, understanding this is one of the smartest things you can do for your financial future.
You've heard this a million times, right? Of course you have. Well, it turns out this isn't just some old-fashioned saying. It's actually the simple, brilliant idea at the very heart of a powerful investment strategy that pros use every single day.
So, in the world of finance, that piece of common sense gets a slightly fancier name, diversification. Let's break down what that really means when we're talking about your money.
At its core, diversification is really a defensive move. Instead of betting the farm on one single company or one industry, you're spreading your money out across a whole bunch of different bets. The goal isn't just to pick winners, it's to make sure that one loser can't sink your entire ship.
Just look at the two extremes here. On one side, you've got the high-wire act, right? A concentrated portfolio. If that one stock you bet on goes to zero, you could lose everything. Poof. But on the other side, with a diversified portfolio, if one investment does poorly, it's just a small dip. Its impact is cushioned because all your other assets are there, holding things steady.
So what does spreading your investments actually look like? Well, it's about creating variety on a few different levels. You're not just buying different stocks. You're buying totally different types of investments, like stocks and bonds. You're investing in different industries, think tech and healthcare. And you're even looking all over the globe, investing here in the US and internationally. Okay, but why does this actually work? What's the magic trick? The secret isn't just owning a lot of things. It's owning a lot of different things that don't all move in the same direction at the same time. It's all about finding these mismatched assets.
You know, it feels kind of intuitive, doesn't it? But there's a very specific financial principle that explains the magic behind this whole thing. And to really get it, we need to talk about how different investments relate to each other.
The secret sauce is one powerful word: correlation. This is the key to everything. And correlation is just a technical-sounding term for a really simple idea. It measures how two investments move in relation to each other. Do they go up and down together, or do they kind of dance to their own beat?
Let's break that down. You've got high correlation. That's when two assets are basically linked at the hip. Think of two big tech stocks that tend to rise and fall on the same news. But the real goal, the sweet spot, is low correlation. That's where assets move independently. A classic example is stocks and bonds. Historically, when the stock market zigs, the bond market often zags. And that opposition is what creates real stability.
So here's the bottom line. You want to fill your portfolio with investments that don't all react the same way to the same news. That way, when one part of your portfolio is having a bad day, another part is steady, or maybe even having a good day. It just smooths out the whole ride and protects you from those huge stomach-churning swings.
Okay, so we get the why. We want assets that don't move in lockstep. We want low correlation. Now let's get practical. How do you actually build a portfolio that puts this amazing theory into practice?
Just think of it as a four-step roadmap. First, you lay the foundation by investing across the big, major asset classes. Then, you add another layer by diversifying within those classes. Third, you expand your horizons and go geographic. And finally, and this is super important, you do a little maintenance by rebalancing every now and then.
Step one is the big one: asset classes. You can think of these as the main food groups of your investment diet. You gotta have a mix. So that means stocks for growth. That's you owning a small piece of a company. You need bonds for stability. That's basically you loaning money to a government or a company. And maybe even things like real estate or commodities to add even more flavor to the mix.
All right, now you add some more layers. So inside your stock bucket, for instance, don't just buy a bunch of tech companies, own some healthcare, some industrial stocks, some consumer brands. And don't just own giant companies, mix in some smaller ones too. Then you apply that same logic to the whole world. Own companies here in the US, in other developed countries, and even in emerging markets.
So now we come to what might just be the most incredible part of this entire concept. You see, in the world of finance, where pretty much every advantage comes with a cost, diversification has been called the only free lunch in investing.
Yep, you heard that right. That powerful portfolio-saving protection that diversification gives you, it's totally free. Now, I know what you're thinking. That sounds way too good to be true, right? So what on earth does free actually mean here?
This is the magic. See, normally, if you want to lower your risk, you have to accept a lower potential reward.
It's a trade-off. But with diversification, that trade-off just disappears. You get to seriously lower the risk and the volatility of your portfolio without having to give up your expected long-term returns. It is, without a doubt, one of the most powerful risk management tools you have at your disposal.
And that really brings us to the ultimate takeaway here. For the vast, vast majority of us, the smart, proven path is to spread your bets out wide instead of concentrating them all in one place and just hoping you hit the jackpot. At the end of the day, diversification puts the power to manage risk directly into your hands. It's not about trying to predict the future. It's about being prepared for it no matter what it throws at you. It all comes back to that simple piece of wisdom we started with. So the final question is for you to think about. Take a good look at your own investments. How diversified is your basket?